We're in a challenging situation right now. When bond markets collapse, the stock market inevitably follows, creating an enormous ripple effect. What's coming will likely be the largest wealth transfer in the history of money. Today, we're focusing on what real money actually is, not this fake paper currency that people mistakenly rely on. Honestly, I can't understand why people dedicate their efforts to earning and saving something that, to me, is as worthless as toilet paper. Our goal today is to help people break free from the misconception that this paper represents true value. Recently, they've printed even more of it without much public attention. This surge in money creation was an attempt to stabilize failing banks like Silvergate and Silverado. To prevent a broader collapse, they essentially took treasury bills, normally seen as safe assets, and turned them into liquid funds, flooding the system with more of this so-called money. I bring this up because I often clash with friends and family over this issue. They cling to this currency, trying to save it, even as the Federal Reserve and the Treasury pump trillions more into circulation. As someone with Japanese roots, I find this particularly ironic. The Japanese are among the world's top savers, yet they primarily save yen and US Treasury bills. Despite their academic success, getting into prestigious institutions like Harvard, Princeton, and Yale, they lack a fundamental understanding of money. Saving yen, in my view, is almost laughable. I wouldn't even use yen as toilet paper. That's how little I think of its value. Despite this, many Japanese proudly save yen, while their government continues to print trillions of it. Friends often ask me, "You're telling people to buy silver, right?" I respond, "Yes, but have you bought any?" Most admit they haven't. Years ago, when we started advocating for silver, it was priced at just a couple of dollars per ounce. It's baffling that even now so many people remain stuck in the old mindset. Silver is now around $24, yet the value of the dollar continues to decline. Despite this, people persist in saving paper currencies, whether it's dollars, yen, pesos, or euros, which I consider just as worthless. Would I save yen? Absolutely not. I wouldn't save the US dollar either, nor any other paper currency at this point. The relentless pace of money printing seems to worsen every year, devaluing these currencies further. The dollar, in particular, is on a steady downward trajectory, and the situation is only deteriorating. Take the last 6 months as an example. When banks like Silverado and Silvergate faced collapse, the Federal Reserve attempted to curb inflation by raising interest rates. However, this move led to the bond market crashing, which in turn caused the stock market to follow suit. For the baby boomer generation, my generation, this is a serious crisis. Many are saving assets like paper currency, stocks, bonds, mutual funds, or ETFs, none of which I would personally invest in. You can choose to rely on them if you like, but I don't have to. I own physical assets. I own minds and businesses because I'm an entrepreneur. The problem is that so many people are being set up for failure. This isn't a new issue, it's been building for decades. I often look for tipping points, and one major shift came in the year 2000. After the dot-com bubble burst, Alan Greenspan began printing money at unprecedented levels. Back then, the US had $5.6 trillion in debt on its balance sheet. Today, that figure has skyrocketed to $33 trillion. What does this mean for real money? In 2000, gold was trading at just $275 an ounce, and silver was around $3.50 an ounce. With all the additional paper money in circulation, tangible assets like gold and silver have increased significantly in value. This is the fundamental concept people need to grasp. Every time more paper money is printed, its value diminishes, while the value of tangible assets rises. Right now, artificial intelligence, AI, is the next big trend everyone is talking about. I recently discussed this topic during an event hosted by my friend Ken McElroy. While AI may be the future, the lesson remains the same. Real value lies in tangible, physical assets, not in printed paper or fleeting trends. Someone asked me, what is AI? Is it like a college degree? The truth is, a college degree won't teach you anything about money. My own father, who had a PhD, was what I call a poor dad. I used to joke that PhD stands for poor, helpless, and desperate. Then there are financial planners. These professionals only earn their commissions by selling paper assets, so they'll never recommend gold or silver. It's not in their interest to do so, which is unfortunate. If we look back to the year 2000, the numbers tell a compelling story. Some people may disagree with this time frame, but I like using long-term horizons as a reference. If you had invested $100,000 in the stock market in 2000, excluding dividends, that investment would be worth about $320,000 today. But if you had invested $80,000 in the stock market and $20,000 in gold, that portfolio would now be worth $385,000. That's an additional $65,000 simply by allocating 20% to precious metals. Why? Because as more paper money floods the economy, its value erodes, and tangible assets like gold increase in worth. This principle has stood the test of time. You've seen it yourself. Investments in real estate and precious metals, both tangible assets, have consistently appreciated. Those who moved away from paper money and embraced physical assets have done significantly better. For me, it's simple. I don't trust anything they can print. That's why I invest in oil, not in companies like Exxon or Standard Oil, but in the oil itself, still in the ground. It's not something they can manufacture or devalue by printing more. This philosophy is at the core of what Rich Dad stands for. We don't advocate for chasing degrees, earning a PhD, and then spending your life looking for a job. That mindset doesn't work, especially in today's world. With the rise of AI and automation, unemployment is poised to skyrocket. Economic experts like Rickards are predicting mass layoffs as the economy heads toward a recession, or even a depression. Manufacturing companies across Europe and elsewhere are already struggling. Jobs are disappearing, and people are facing an uncertain future. Now, more than ever, the focus should shift to assets that hold real, lasting value. There's no work coming in, and China hasn't saved the global economy. Meanwhile, people continue going to school, looking for jobs, saving money, and putting that money into 401ks, IRAs, mutual funds, and ETFs. Personally, I don't trust anything that can be printed. That's why for years I've been saying, buy silver. But has anyone actually done it? No. People continue clinging to paper currencies like yen or dollars. They feel wealthy when they see numbers in their bank account. But is that real wealth? I believe the allure lies in the illusion of seeing a large balance on a screen. Yet that money is just sitting there, doing nothing. For years it earned no interest. And even now, with slight increases in interest rates, the returns are still below the rate of inflation. In the end, it doesn't help anyone. This is why education about money is so crucial, especially now, with artificial intelligence reshaping industries and governments printing money at breakneck speeds. People need to start paying attention. The job market is only going to get tougher in the coming years, with massive layoffs on the horizon. Consider this. In one building in the heart of Los Angeles, about 25% of the space is completely vacant. I just renewed my lease at the same rate I signed for 8 years ago. Why? Because the building owners had no choice. If the lease rates go any higher, more tenants will leave and the banks won't refinance their loans. This situation shows the broader reality. Commercial real estate is struggling and vacancies are becoming the norm, even in major cities. If a quarter of a building in Los Angeles is empty and they can't fill it, imagine the ripple effects throughout the economy. Many people are moving to Arizona these days. I saw the writing on the wall about 30 years ago when California attempted to tax my worldwide income. Most people don't understand what that means because they don't have income streams coming from all over the world. But as an entrepreneur, I do. When California decided they wanted a cut of that, I said, adios, and left the state. Even after you leave, California tries to keep taxing you, which makes it one of the least tax-friendly states. It's almost surreal, like we're living in a bad science fiction movie. And Kevin, this movie just keeps getting worse. The relentless money printing by the government is a prime example. They have no choice but to print more money. It's all they know how to do. It's not just about lacking alternative solutions, it's the very nature of the system. Let me illustrate with a simple example. Imagine you and I live on a small island. You're the banker, a smart guy, and you control the island's entire money supply, which consists of 10 shells. I come to you with an incredible business idea, and you agree to loan me the 10 shells at a 10% interest rate. I take the 10 shells, invest them to start my business, and by the end of the year, I manage to earn all 10 shells back. I return them to you, but now I'm out of business. Why? Because there's no 11th shell to pay the interest. As the banker, you have to create that 11th shell out of thin air so I can pay you. This is essentially how governments and banking systems operate. They have to keep printing money to cover interest and debt. That's why this piece of paper we call money keeps losing value over time. It's going to become increasingly worthless because the system requires more money to be printed. And yet people are told to save money. Save what? Something that's consistently losing value? It's a cycle that doesn't make sense. Every time a new dollar is printed, the value of that shell diminishes further and further. People don't seem to grasp this. They think they're earning when they're offered 3% interest, but inflation is running at 6%. Do the math. If I'm earning 3% but losing 6% to inflation, what's happening? I'm still losing, just more slowly. That's the reality people fail to see. And honestly, I can't believe how blind they are to it. It's frustrating. But let's keep this civil. No harsh language here. The Consumer Price Index, CPI, measures inflation, but even that doesn't fully capture the erosion of money's value. This paper currency is turning into toilet paper, and it's happening faster every day. For full disclosure, I don't hold paper assets. I own tangible assets like gold mines, silver mines, and oil wells. Why? Because I don't trust the government, Wall Street, or the Federal Reserve. They've proven time and again they can't be relied upon. If you have friends, family, or even that neighbor who's still saving in paper currency, sit down and have a discussion. Ask the critical questions. Is this money? Or is it trash? Are you actually losing by saving it? It's an important conversation to have. Take my family as an example. We are fourth-generation Japanese, yet we still act like traditional savers. My siblings hold on to money because that's the mindset they were taught. But I ask them, would you save the yen? Yet that's exactly what many Japanese do, save yen. Mexicans save pesos. Europeans save euros. Americans save dollars. This isn't intelligence, it's ignorance when it comes to understanding money. And schools? They teach nothing about money. That's not an oversight, it's intentional. Take silver as an example. Back in 1991, it was about $3.75 an ounce, even dropping to $2.75 at one point. That's when Warren Buffett invested heavily in silver. Today, silver sits at around $25 an ounce, a significant increase over the years. For decades, I've been encouraging people to invest in gold and silver. Why? Because I don't save dollars. When I have extra money, I convert it into tangible assets. That's my strategy for protecting wealth in a system that constantly devalues its currency. I invest in gold and silver and store it securely in a vault located far away from my home. I once shared a stage with someone who proudly mentioned keeping his gold and silver at home. My response? Why not just invite everyone over while you're at it? It's a terrible idea. Never keep it at home. There are plenty of cautionary tales about why this approach is risky. One story involved a wealthy individual who owned a substantial amount of gold and silver. He had a floor safe in his house and went on vacation. Unfortunately, his child showed the safe to a friend next door. When they returned, they found someone had rented a jackhammer and was halfway through digging out the safe. The culprit? The child had rented the jackhammer. Stories like this highlight why keeping valuables at home is a mistake. Let's revisit the desert island analogy with the shells as currency. Imagine there are only 10 shells on the island, and you loan them to me at a 10% interest rate. How can I repay you when there aren't enough shells to cover the interest? The banker would need to create an additional shell out of thin air for me to pay back the loan. This analogy illustrates why governments must print more money each year. It's inevitable. If you believe the dollar will gain value, that assumption hinges on the government halting money printing. But if they stopped printing, the economy would collapse. That's why paper money continually loses its value over time. Here's something interesting to consider. Central banks appear to be taking this issue seriously. Last year, central banks purchased 25% of all the gold mined globally. Reflect on that for a moment. Why would they make such significant acquisitions if they believed in the stability of paper money? This trend should raise important questions about where the financial system is heading. Central banks are printing money out of thin air and using it to purchase substantial amounts of gold. Last year alone, they acquired 25% of the 1,250 metric tons of gold mined globally. This behavior reveals something crucial. They don't even trust their own currencies. Consider the staggering numbers involved. When the US debt ceiling was at $30 trillion, few truly grasped the magnitude. To put it into perspective, 1 trillion seconds equals 32,000 years. That's the official on-balance sheet debt. But when you factor in off-balance sheet liabilities, such as Social Security, pensions, Medicare and Medicaid, the total debt is closer to $100 trillion. This off-balance sheet debt is particularly concerning because as more people retire, these liabilities will shift onto the balance sheet. The government will need to borrow more to meet these obligations, worsening the debt crisis. This shift will likely lead to a further devaluation of the dollar, with potentially severe consequences for the economy. Meanwhile, there's another looming factor: the BRICS nations. BRICS, representing Brazil, Russia, India, China and South Africa, is a group that initially consisted of 5 nations. However, by the time their upcoming meeting takes place, an estimated 41 nations may join their ranks. What's driving this expansion? Frustration with the US and its reliance on fake money. The BRICS countries, along with their potential allies, are fed up with being paid in increasingly worthless paper currency. They are reportedly considering creating a new currency backed by gold. If this happens, it could trigger the largest wealth transfer between nations in the history of modern finance. These countries are positioning themselves to reject the US dollar, symbolically likening it to toilet paper. While most Americans remain oblivious to these developments, the BRICS nations are making their displeasure known and preparing for significant changes in the global financial system. The 5 BRICS countries, Brazil, Russia, India, China and South Africa, together represent 40% of the global population, approximately 3.2 billion people. If additional countries join this alliance, pushing their collective population to 50% or 60% of the world's total, the dominance of the US dollar could be severely threatened. The tipping point would signal a massive shift in the global financial order. To understand the potential consequences, imagine a new BRICS currency backed by gold. This approach bypasses the reliance on paper currency and creates a direct connection to tangible value. The United States currently runs a massive trade deficit, nearly $960 billion as of last year. If global trade operated solely in gold, the US would effectively be transferring vast amounts of wealth in the form of gold to other nations in exchange for consumer goods like toys, clothing and vehicles, items that depreciate over time. In this scenario, countries exporting goods to the US would accumulate substantial reserves of gold, strengthening their financial positions. Meanwhile, the US would deplete its gold reserves, further undermining the dollar's value. The demand for gold would likely drive up its price, increasing the value of a gold-backed BRICS currency while simultaneously devaluing the dollar. This imbalance would exacerbate the US trade deficit. With gold replacing paper currency in international trade, the US would lose not only wealth, but also economic leverage. For context, consider real estate. The total US real estate market is valued at around $70 trillion. If the US effectively traded $1 trillion worth of its real estate to other countries, that would represent 1.5% of its total market. Over 6 years, this could amount to 10% of US real estate being effectively transferred abroad. Now apply this logic to the broader economy. If the US continues trading valuable assets for depreciating consumer goods, the imbalance deepens. The result? A massive transfer of wealth, potentially the largest in modern history, from the United States to other nations. At the same time, as the BRICS countries shift away from the dollar and adopt their gold-backed currency, the US dollar would be repatriated. This sudden influx of devalued dollars back into the domestic economy could trigger skyrocketing inflation, further eroding the purchasing power of American households. This chain of events underscores the risks tied to the current trade and monetary systems and highlights the potential impact of a BRICS-led financial revolution. Paper money has no inherent value, and a gold-backed currency would likely attract global attention. If trade partners shift to such a system, the US would need to acquire gold to facilitate transactions, effectively transferring its gold reserves to other countries. This dynamic could make even basic goods like a Barbie doll disproportionately expensive as the value of the dollar diminishes. Personally, I don't save cash. Instead, I leverage debt to invest in real estate using 100% financing. While I don't recommend this approach for everyone, it works for me. When I generate cash flow, I immediately convert it into tangible assets like gold and silver, which I store securely in places like Switzerland, far from prying eyes. My involvement in this space runs deep. I've even taken a gold mining company public in Utah and own a silver mine in Argentina. For those starting out, particularly individuals with an IRA, individual retirement account, I advocate saving in physical gold and silver rather than cash. I don't invest in paper gold or silver, such as ETFs like SLV for silver or GLD for gold. These represent paper versions of the metals, often held by third parties in locations like HSBC Bank in Hong Kong or the UK. The issue is that these ETFs don't guarantee 100% backing by physical assets, leaving investors with an abstract claim rather than actual ownership. The concept of hypothecation compounds the problem. It means the same piece of paper, gold or silver, can be sold multiple times, 10, 20, or even 30 times over. If investors simultaneously decide to cash out, the system could collapse, revealing there isn't enough physical gold or silver to fulfill the claims. This risk could become particularly relevant if the BRICS nations intensify their focus on gold this year. For these reasons, I encourage people to save in physical gold and silver instead of dollars. The government will continue printing money, further devaluing the dollar as debt grows and the economy weakens. Financial experts like Jim Rickards also emphasize the importance of gold, predicting it could reach $15,000 an ounce, compared to its current value of around $2,000. Ultimately, many knowledgeable individuals don't trust the dollar, the Federal Reserve, the Treasury, or Wall Street. In uncertain times, tangible assets like gold and silver offer a more reliable store of value than increasingly inflated paper money. If you continue saving paper money, what does a school teacher really know about finances? Not much. The entire financial system is in trouble. My main concern is that inflation has become a permanent issue. When Powell claimed inflation was transitory, that was misleading. When Biden shut down the Keystone XL pipeline, the price of oil surged from $30 to $120 per barrel. That was inflation, not just the printing of money. As a result, the value of money has decreased, and that's what worries me. The key question is not what the Federal Reserve will do, but what you will do. I've always followed a strategy based on the 4 Gs. The first G is gold. I avoid ETFs like SLV and GLD because I want to avoid counterparty risk and prefer physical gold. I don't invest in farmland either, but I do own apartment buildings. I'm grateful I stayed out of office buildings or commercial real estate. Another G is gasoline, which is essential for transportation and industry, even though environmentalists oppose it. Finally, I invest in food, specifically cattle and other food sources. As inflation rises, the value of gold, real estate, gasoline and food all increase. So I choose to invest in assets that will benefit from inflation rather than against it. I'm a strong proponent of financial education. In the 1970s, after I left the Marine Corps, my rich dad made me learn two things. First, I had to master selling because sales generate income. Second, I learned how to invest in real estate because real estate is tied to debt. While most people are taught to live debt-free, I was trained to use debt as a tool for wealth building. In 1971, Nixon took the dollar off the gold standard, turning it into debt. Since then, I've focused on doing the opposite of conventional advice. I don't avoid debt. Instead, I use debt to acquire real estate and minimize my taxes. Additionally, I own shares in companies I've taken public. I've launched two companies, one on the Vancouver Stock Exchange via an IPO and another on the New York Stock Exchange. I don't trust anything that can be printed. I prefer tangible, hard assets like commodities. Real estate, for example, depends on job growth, which is another reason I invest in it. I'm concerned about the upcoming layoffs in the tech sector, so I'd advise being cautious about job security. I live in Phoenix, Arizona, and the job market here is strong, partly due to companies like Taiwan Semiconductor setting up operations here. For young people, I recommend taking a real estate investment course. These courses don't cost much, and I view crises as opportunities. When times are tough, prices tend to be lower. For instance, after the 2008 financial crisis, I borrowed $300 million to invest in some of the best real estate available. Before diving into real estate, it's important to educate yourself. Real estate isn't as liquid as stocks. If I buy Apple shares and later decide I don't want them, I can sell them quickly. But if I purchase a property, I'm stuck with it for a while. The more liquid the investment, the less expertise you need. But with less liquid assets like real estate, you need to be more knowledgeable. I've had disagreements on YouTube with some real estate investors who promote strategies I believe are too risky. Again, real estate is illiquid while stocks are liquid and easy to buy or sell. Investing in illiquid assets requires greater competence. Wealth isn't about how much money you have, it's about how long you can survive without working. For most people, it's only a month before they run out of money. I follow three key principles. First, the rich don't work for money, they work to acquire assets. Second, savers are losers because inflation and taxes erode savings. Third, your house isn't an asset. The average person buys a house they can't afford, and instead of it being an asset, it becomes a liability. I don't rent my own home, but I have enough investments to cover my mortgage. I believe owning real estate is a good way to replace a traditional pension, though gold and silver are also valuable assets to hold. I have a significant amount of both. As for gold and silver, I'm confident their value will rise. For example, silver might be $35 today, but in 2 years, I believe it could reach $100. While it may fluctuate due to inflation, it's still a safer bet than most other assets. When given a choice, many people would choose to hold physical assets like gold and silver over paper money.